Joining us now is JP Morgan Asset Management Global Strategist David Kelly. David, good to have you here.
Glad to be here.
I don't know. I know you've been walking around, but we just got the sentiment data. Very, very weak. Does it matter?
Not actually for consumers. First of all, I would be a little careful about this number. They only poll about 250 to 300 people, which is way too low for a survey, in the first half of the month. So the survey sample is size really small. In addition, they made a change to that survey last year, moving from telephone interviews to online interviews, which we think cost them 6 points. So it's not quite as bad as it looks. I mean, it is. But having said that, look, consumers are resilient. But there comes a point where you squeeze them enough in terms of tariffs, we're collecting on the student loans again, and then just the general worry that and of course the cutbacks to the government sector. All of these things I think are beginning to weigh on consumers. So I think it is slowing the economy down. Still not willing to say recession.
Right.
The really key question here is not consumer behavior; it's business behavior. Because businesses seem to be so reluctant to lay people off. They had such a hard time hiring people the last few years that until they see the whites of the eyes of the recession, they don't want to lay people off. And actually, when you look at retailers, until they see the whites of the eyes of recession or the tariffs, they don't really want to push up these prices. They'd rather say, well, look, on the current stock, this is what it cost us. This is our markup. Here we are. Now, the new stuff that comes in at the ports, that's going to be more expensive for us, so we're going to mark that up. But I think they're also playing wait and see. So everybody's waiting to see what these tariffs really do to the economy.
Well, looking at JP Morgan's analysis of retail sales, we just mentioned it, but if in fact they're eating some of the tariffs through their margins, your argument is that's not good for the economy either.
No, I mean, the whole and the uncertainty. I mean, there's this uncertainty tax which is being levied by Washington, which is bigger than all the other taxes combined. I mean, it's you have to, in business, small business, big business, you have to make decisions. And what happens is everybody freezes. And what I think people don't realize is we've got such a dynamic labor market. And if you look at the job openings labor turnover report, we hire 65 million people per year in this country. 62 million people lose a job, but 65 million people get hired. That's 250,000 hires per day. If you just hold off a little bit, maybe let's just put a pause. We're not going to approve this hire. You just do that a little bit, it can really slow the economy down.
We're not seeing any signs of it yet, are we?
No, we're not. At the moment, I'd have to say, the tariff pullback and also this big tax bill, which is going to put stimulus into 2026 and a little stimulus into 2025. That takes us from more than likely going to have a recession to less than likely we're going to have a recession this year. So I think the economy may be resilient enough to avoid recession, but it's going to be slow growth for a while.
Although one caveat you guys threw out there this week was that there's a chance those things don't go as well as some hope. The regulatory and the fiscal stuff. Oh,
well, yes. I mean, first of all, it's going to be a difficult thing getting this whole bill through Congress. But the other part of it is, longer term, we're pushing up the deficit again. We're going to end up in 4 years' time with a deficit close to 7% of GDP. It's 6% of GDP right now. It's going in the wrong direction.
Because of slower growth.
Well, partly because of slower growth, but guess what? We've also had another dose of fiscal fudge. We've got four years of tax cuts.
The tax bill
is paid for 10 years of future spending cuts, and we see this all the time.
And we hear warnings about this all the time, but is there really any evidence, David, that it's going to stand in the way of an equity market rally or even a bond market rally? Even when we had these higher yields, we were wondering, is the deficit front and center again? But guess what? Then we see buying reemerge.
The bond market maybe, because we're going to have to spend $2 trillion per year financing. We're going to have to find $2 trillion per year just to finance this deficit, going up to $3 trillion. And we also have this ongoing tariff issue. We're going to be close to full employment. We've got less available workers. All these things say to me that inflation is not going to collapse. If the economy doesn't collapse and inflation doesn't collapse, the government's borrowing all this money. Pretty hard for the long end to rally that strongly.
Does that become an issue for equities ever?
I think it's all an issue for U.S. equities, U.S. fixed income. I mean, 60-40 portfolio has done so well for so long. People have got to calm their expectations here, diversify. International still makes a lot of sense. Value stocks still make a lot of sense. There are plenty of things to do, but don't just bet on large cap growth stocks with a little bit of bonds added in and expect to get double-digit returns per year, because I just don't think that's where we're headed.
And you don't think the tolerance for pain out of retail traders might make that a difficult thesis? I mean, they never gave up the ghost in April.
No, because we've been taught so many times to buy the dip. But at some stage, earnings matter, and even those confidence numbers. I mean, they may feed. As I say, consumers are resilient, but investors might get a little nervous.